Hello, everyone. I'm Shweta Goswami. I run sales for Guardian Capital Partners. Thank you for joining us. This video is an introduction to Guardian Capital Partners. We will be talking about our investment philosophy, the team, and our journey so far. We have Manav Saraf and Kabir Kevalramani, the two founders and CIOs at Guardian Capital Partners. I'd request Manav and Kabir to talk about themselves a bit before we get into the discussion on various aspects of their investing style. Over to you, Manav.
Thanks, Shweta. I started my career in the late 90s in Indian private equity when it was quite a cottage industry. I was part of JP Morgan Partners. We worked on transactions which we would all love to do today again. We own 15% of HDFC Bank, household names like Domino's Pizza and MTR Foods. Then I went on to Citadel. Citadel is one of the largest global hedge funds. I was running the India business there. And most recently, I was part of Lone Star Funds. Lone Star Funds is a $100 billion plus private equity house. I was running part of their business, the India business, and the financial space for Asia. That's before quitting and starting Guardian Capital Partners in 2020, along with Kabir. I'll cover the details as we go along. Kabir, you.
Thanks, Manav. So I started my career also at JP Morgan Partners as an analyst in 1996. Post JP Morgan, I actually participated in the buyout of a bankrupt concrete business called RDC Concrete. Was the beneficiary of the last big capex cycle before this one, between 2003 and 2008. RDC became India's fourth largest concrete business. I sold that, exited to a large private equity fund called True North. Post which went out to work for another investment house called Bagroon Holdings and looked at the investments across India and Asia. In 2020 early, Manav and I set up Guardian.
Thanks, Kabir and Manav. You both have had long and very successful careers. Kabir, could you also give us the genesis of Guardian Capital?
So the genesis, Shweta, was the fact that Manav and I both started our careers at JP Morgan as analysts. Both of us got to know each other well. Our training was kind of similar to start off with, and then we stayed as friends. We both invested our own capital together in 2008, where frankly, we had always learned theoretically that we should buy when markets are low and sell when they're high. So when the GFC crash happened, we both actually made our first real investment. That actually turned out to work very well for us. We've been investing our capital together. One of the key themes that we've really followed is whenever there's been panic, we should buy. So we bought into pretty much every panic that existed from after GFC was Colgate, was UPA2, was demonetization, and most recently COVID. The strategy really is the strategy that we've actually taken into Guardian is something that we both had been following for 12 years at that point, now 16 years. In the last 4 years within the Guardian framework, it's a little bit more tighter with a few more bells and whistles attached, but it's really we got the confidence for the strategy over the last 12 years before we started Guardian.
Absolutely, it's interesting to know how the strategy has evolved over years. Kabir, can you also give us a brief on our investment objective and how we've fared through different investment environments in terms of performance?
So the objective is reasonably simple, tough to do. We try and deliver in excess of 20% returns consistently over a long period of time. I'm going to show you our returns sheet. Over the last 51 months, which is 4.25 years, we've delivered about 36.2% returns, which really is an outperformance of 21.6%. We've done this with minimal volatility in our portfolio. How do we do this, I think, is the question. We try and buy good companies when valuations are attractive. When they are not and markets are irrational, we try not to chase them. We focus on making lesser mistakes. This return of 36.2 has been delivered on the back of 37 investments that we've made. 34 of them have age on their side. So if I talk about them, each one of those 34 investments have delivered in excess of 20% returns. So it's not like a one-off one stock that's done really well and a few that haven't done well. It's been consistent performance across the portfolio. Our big belief is to deliver consistent returns, we need to make lesser mistakes, which is thus far been evident by our stock selection.
Thanks, Kabir, for the insights. Manav, we say our strategy is to buy good companies if they are cheap and only if they are cheap. And if they are not cheap, we stay on sidelines in cash for periods. Can you throw light on what do you mean by good companies and what kind of cheapness are we looking for?
Sure, exactly. I'll spend time on both these elements. Let's first take this word good companies. We've left it vague, good companies. It means a combination of two things. Good business, really mean in a sectoral sense. We'll talk about that shortly. And good promoter, stroke senior management team, and we'll talk about that. A combination of these two make it a good business. Good focus sector is a function of understanding all the elements that drive that business and that sector. In many of the larger sectors, this is easily visible. Part of our business is in smaller companies. For that, we have to do a lot more on the groundwork to make sure that we've got a very detailed view of the business and the sector to be able to establish that capital allocation is right, all the other elements that we would consider good business practices. The second part of this is good management, and this is really tough to do. We break our universe into large companies and small companies. Large companies, broadly, the top 250 companies in the country in market cap sense. In the AMFI definition, large and mid caps, we bucket together and call them large companies. And the next 1,000 or so companies, what would be the larger small caps, is our segment for 30% of the portfolio. In the first bucket, in the larger companies, we've predefined 30 companies as having poor corporate governance standards in the past, and we don't invest in them. The other 220 companies are fair game, but even there, when we are making an investment or thinking about an investment, we will study a whole lot of things again to establish that the current behavior, current corporate governance is that of the reputation of the company. This will include pledges, intergroup activity. A lot of these are business group companies, working capital management, and how, if there are any signs of weakness around behavior around the working capital, things like that, which a lot of which can be done on desktop basis, some which requires primary work, which is why a typical large cap name, larger company name will take us 1 to 3 months from ideation to investment. In small caps, it's almost always above 3 months because getting a validation of promoter is a must for us over here. In many cases, these are lesser known promoters. We may or may not have access directly to the promoter or people around him. What we try and do in a very private equity sense is establish this reputation by talking to competitors of the promoter, talking to ex-employees, ex-board members, other related parties, for example, customers and suppliers to the company, to establish that the business practices of this company and group are what we can broadly call good corporate governance. A combination of these two is what then we call a good company. Not only are we looking to do good companies, we're looking to do them when they're cheap. And this word cheapness means different things to different people. So I'm just going to spend a minute here. First thing I'd say, broadly speaking, cheapness can be defined as cheap relative to a fair value. Fair value by nature has a lot of, everyone will have a view as to what fair value means for a specific company. We practice at least 5 distinct forms of cheapness in the previous 51 months or so, and those are worth talking about. Let's talk about the first one, which is GARP, growth at reasonable price. Growth at reasonable price is something that everyone loves to do in India and is the most difficult to do, because when growth is found and established that this is a good company which is growing well, typically tends to trade away very quickly and become very expensive. An example of GARP in our portfolio, we've had a few, but probably the best example is Aster DM, which is a hospital chain, which we did. It was trading at 7 times EV/EBITDA when the hospital space was trading well above 15. And we really like the quality of the company. Specifically, GARP to us means higher than industry growth rates at lower than industry valuations. The second form of cheapness that we've practiced a lot is what I'd call cheap relative to self. An example today on our books would be HDFC Bank, a very hotly debated name in the street. Everyone has a view. For us, this company has traded at 22 times forward, 23 times forward on a price to earnings basis. If you look at a clean decade or so of data, 2010 to 20, which is after GFC and before COVID, today it's trading at 15 to 16, part of which is to do at least with a cyclical element around deposits. For us, that's a huge opportunity. It is a key stock in our portfolio. Another form of cheapness would be considered cheapness relative to industry. Every name in a sector has a relative importance. I'm kind of sticking with financial services, banks. Axis Bank should be cheaper than ICICI Bank. ICICI Bank should be cheaper than HDFC Bank. You can go back and sort of measure as to how much cheaper. When we look at Axis, we bought in at 1.3, 1.4 times book, when in our view, fair value was well north of 2. So that's an example of cheap relative to sector, and even within that, its sectoral position. A fourth type of cheapness is cyclicals. We had a lot of opportunity here 2 years ago. This is early 22. You've seen a COVID rebound, which is causing a shortage across commodities, causing commodity prices to go up. And then the Ukraine-Russia war starts and causes many of the key commodities, crude included, to go out of whack. If you remember, crude was above 125 at this time, steel was above $1,000 a ton, palm oil was above 4,600, etc. We saw this as a huge opportunity where we took a view that these numbers will normalize over our investment horizon, which for any name, we usually have 3 years plus. So we said, who will benefit from the normalization of these prices? These are going to make great investments over the next few years. We invested in a whole host of companies to benefit from crude falling, gas falling, steel falling, soft commodities falling. An example which is worth talking about is IOC, which we've been in the process of exiting, and we have this last bit left to exit, but it more than doubled, and a large component of that was crude normalization. Another form, and probably the last one I'll talk about, is contrarian investing. Contrarian investing means, again, different things to different people, and you could argue a lot of what I've already said is contrarian investing. But here I specifically mean where we have a contrarian view, a different view to the market, even on the operating fundamentals of the name or company or the sector. An example worth bringing up here would be Manappuram. Manappuram is a gold loan company. When we were investing in Manappuram, the sector had seen about 500 basis points of reduction in yields, 22 to 17. And the view on the street was this was permanent because the big banks had entered and reduced the competitive advantage that the historical gold loan companies used to enjoy. Our view was different, and we backed this view with on-the-ground research. We had village-level access, and we'd gone and done many months of work to establish that in the smaller ticket size, 20 to 50,000, which is bulk of the business, there was actually no price erosion. And really the price erosion was in the 5 lakh plus ticket size, principally in the urban centers. That gave us the confidence through that primary research to take the contrarian view, and that has worked out quite well for us. So at least 5 odd different versions of cheapness I spoke of over there. good companies, when they are cheaper than their fair value, put together becomes something that is an attractive investment for us.
I think it will be interesting for our viewers to know how does the current portfolio look in terms of characteristics. Kabir, can I request you to throw some light on it?
So let me first give you a sense as to what the risk management strategy on the portfolio is. We typically have a minimum of 15 stocks, maximum of 30, right? In the portfolio. At any given point, typically it'll be about 20 to 22 stocks, so reasonably concentrated portfolio. You would have heard right throughout Manav telling you that we have 70% of our capital goes into the top 250 companies. Any investment that we make in these companies can be as high to up to a maximum of 10% of the portfolio. We typically start at 5, 7.5, or 10. 10 is a high conviction bet. On the smaller cap names, we started about a 2.5% position on the portfolio. If it's a high conviction bet, we can actually ramp it up all the way up to a 5% position. So that's kind of the risk management strategy. Right throughout this entire interaction, you would have heard us both say how valuations are important. We try and buy into a margin of safety. That's kind of evident if you look at this slide. You'll see our price to earnings multiple trades at about, the portfolio trades at about 15.6 times. That's against 20.9, which is what the index trades at. Adjusted for growth, our portfolio trades at nearly half of what the index trades at. So 0.7 versus 1.3. Our portfolio characteristics in terms of return on equity would be about 16.3%, which also is higher than the index. A lot of these numbers actually kind of go back and like collaborate to the fact that we buy into a margin of safety. Risk return being the critical thing that Manav and I every time look at before we make any single investment and we pull a trigger on any single investment is kind of shown in the Sharpe ratio. Our current Sharpe ratio is at about 1.16. or 116%, which is frankly incredible, and we'd love to be able to hold on to that if we can. Finally, the portfolio, right down, you'll see some of the names over there from HDFC Bank to SBI Life. What you should take away from these are all kind of well-known companies. Manav and I fundamentally are not trying to find the next HDFC Bank, the next Infosys. We're trying to really buy HDFC Bank and Infosys when they become cheap. If I actually go down and pull out the next 20 names after the next 10 names after these also, I can easily say that the viewers would be able to identify them as businesses that they've heard of and know of reasonably well. So the trick for us, and I think the strategy where it really shows up, is buying companies like these, which have a lot of safety built in and still delivering a big alpha to what the market indexes trade at.
Thanks, Kabir and Manav, for a great introduction. This will definitely help our audience get to know what is Guardian Capital Partners all about. I'd like to thank all our viewers for their time and look forward to seeing everyone again for the quarterly update video. Thank you.